I currently invest with a few other syndicators myself as a passive investor. I would say communication style is one factor on whether or not I'm going to invest with them again. One syndicator that I invest with, their emails are 2 sentences. To me, that's not a good indication of how they operate. I most likely will not invest with them again in the future.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name's Randy Smith, and I'll be your host today. And I am really excited to have Jenny Gu with us today. Jenny is the managing partner of Vertical Street Ventures. She's a real estate investor and syndicator, and she is also the co-author of The Overnight Millionaire. So, Jenny, welcome to the show.
Randy, thank you so much for having me today.
Awesome. Really glad to have you here. Why don't we go ahead and just jump off how we always do. Can you tell us a little bit about yourself and walk us through your journey to passive investing?
Sure, yeah. So, today, as Randy mentioned, I'm a managing partner of Vertical Street Ventures. In my previous life, I am a recovering sales director. I spent 13 years at Procter Gamble managing sales strategies for a few billion-dollar brands, launching initiatives, working with top retailers, had just an amazing time there. I started into real estate because my husband and I, both of us worked for P&G. And so as you can imagine, all of our retirement and all of our savings essentially was tied up with the company. And so naturally we wanted to diversify. And that's when we just happened to meet the right person at the right time, met a broker, real estate agent who also was a property management company. And she helped us get into our first single family property. So like I'm sure many of your listeners, single family investments are typically a good starting point. And then once we started accumulating a couple, said, hey, there's got to be a way we could scale faster, bigger. And so we learned about multifamily. Quit my job in early 2020. Fast forward to now, we have a company that owns, along with our partners, about 350 million of assets under management. So it's a quick recap of the last, call it 5 or 6 years.
This is Chad Ackerman, founder of Left Field Investors, and I'm inviting you to listen to our podcast, The LFI Spotlight. Tired of the Wall Street roller coaster? Discover how to invest in real assets as I interview syndicators, seasoned passive investors, and other experts every week. We'll help you learn about cash flowing syndications, bringing you closer to financial freedom. Visit leftfieldinvestors.com to listen to the podcast, subscribe to our newsletter, and connect with like-minded passive investors. Join us today.
And I love the fact that you talk very highly of your time at P&G. I talk to a lot of folks that, they just hate their jobs. They hate the companies they work for. So it's so refreshing to hear somebody who loved who they worked for, what they did, and all of the valuable experience that you got. So I think it's interesting that I think that attitude and mindset probably follows you into your business today, which is likely why you guys have seen the success that you've seen. So thank you for that. I try to do the same thing as well. My time in corporate America, at least the last 10 years or so, were really the best 10 years of my career. And it was just absolutely fantastic. So
they taught me a lot. And I'm sure you would say the same thing in terms of the success you and I have now in real estate is an output of the skill sets and the managing aspect of it that we learned in corporate America translates over to running a business in real estate and multifamily. So that part is phenomenal. And I'm sure, like other folks who happen to leave a job they love, it just, it wasn't as, I'd say I found something I was more passionate about. So I wasn't running away from something, I was running towards something I thought was better for me and my family.
I love that. Yeah, that's fantastic. And it seems like a different type of motivation or motive or desire that pushes you. And I think it's a stronger desire than running from and running to. So yeah, thank you for mentioning that. So now you, like so many others, did single family investing, and it sounds like you actually did very, very well, and you were able to scale that portfolio pretty significantly. Can you tell the audience a little bit about what that portfolio looked like, what the journey looked like, and then ultimately that deciding moment when you chose to go bigger, faster, larger?
Yeah, so when we first bought our first single family home, it was scary. I mean, it was your first investment property. We really didn't know what we were doing. We were trusting in the person that we called a friend who could lead us through the process. And when we got the keys and we, closed that day, we actually looked at each other and said, "Huh, you know what? I guess that wasn't too bad." And, we were able to rent it out. We had very minimal updates and upgrades to the property, which is great. Um, and we were able to rent it out relatively quickly. And we said, okay, that was a little painless. So let's try another one. And then we tried another one and another one. And then there's one day where we closed on 4 properties in one day. And this was a span between, 2017 and 2019. And we got it up to the point where we bought 10 homes, all long term rentals. Mind you, in the Midwest, this is Cincinnati. This is not in California where we live now. Homes in the Midwest at Cincinnati, I mean, it ranged between 80 grand to 120. So you can imagine much more affordable than maybe somewhere else, in the West or, East Coast, et cetera. And that income, that passive income, I'll call it, that started to come in was starting to get to a point where it could offset some of my salary. And we decided that, if this is serious, one of us could leave. And we decided it would be me, and Ronnie would stay for the stability and the insurance. And, he thoroughly enjoyed his job as well. Um, I would leave, and they said, okay, well, 10 is just, it's slow. You get one and one and one, maybe four in one day, but it was just too slow for us. And we said, well, what are other ways we can go bigger? And we started reading, going to meetups. Ronnie actually went to a Joe Fairless meetup in Cincinnati because that's where Joe is from. And that's when it just clicked for him. And he came home one day and said, honey, we're going to go buy an apartment building. And I said, you are nuts. We're
Yeah.
just, figuring out the single family side. We can definitely go bigger, but are you, in my head, I thought he meant us ourselves. Let's go buy an apartment building. But then he explained the whole syndication method, and it made sense to me. At that point, I said, you know what? I believe it. I learned a little bit more, and I said, let's go all in. Quit my job before buying a single multifamily door, which is quite backwards. But that's how much we believed in the model.
Love it, love it. So, yeah, that's interesting. The single families lead you to bigger, which is a common theme that I hear over and over and over again. I'm curious your thoughts. Do you think the newer investor should jump immediately into multifamily, or do you think that it was good for you guys to do the single family and that should be the path that you pursue? What are your thoughts there?
I get asked this a lot. Knowing what I know now, would I still have started with single family or jump straight in? And I think it's dependent on your goals. So for us, we wanted both cash flow, some sort of cash flow, and a potential for upside on the back end, and then rinse and repeat, right? So the building out our generational wealth was our one of our top priorities. In that sense, I would jump straight into multifamily. For other folks who, maybe they want to be more hands on and they want to do short term rental because they like that aspect of that, or they want to do flips. Obviously, the singles family side would make sense. So I think it's dependent on your goals.
I love it. Yeah, and thank you for sharing that as well. A lot of people think the way that they've done it is the way to do it and the only way to do it, but it really does depend on one, the resources that the person has, both time, money, and expertise, but then also really where do they want to go? And as you mentioned, generational wealth, growing generational wealth was really your target, so that made a lot of sense. So yeah, thank you for that. That's a really good explanation. So you have these 10 singles. Do you still own those today or
Me
did
too.
you do? So those were great investments, kicking off good cash flow, decided to keep those. You got introduced to Joe Fairless, which I'm a big fan as well and have read his book and love his podcast. Did you guys jump in immediately into the syndication space or did you passively invest as an LP first?
Yeah, my journey was a little strange because this thing called COVID happened at the
Oh,
time
yeah.
that I left. So I decided my last day of work was essentially February of 2020. And in California, March 1st, everything shut down. And I had envisioned in my mind, this is what my day would look like. When I left, I would spend, my entire day learning, reading, researching, just planning it out differently. And then all of a sudden, I now have two homeschooled kids next to me getting on Zoom while I'm trying to like talk to lenders and brokers. So it's just very, very different. But it's how you make your time. So most of my time I spent helping the kids with their schoolwork, but a good chunk of it I dedicated to underwriting. Nothing was open, as you remember. Nobody was selling, nobody was lending, but I just used that time to learn. And so when I met Steve, who became my mentor, Steve Louie, and said, "Hey, I will essentially intern for you for free. Let me help you manage your properties so I can quickly learn." I spent the better part of 2020 working with him on his assets and running their weekly calls with the PMs, property managers. And at night, we would underwrite deals and I would show him, here are the 5 deals I'm looking at. What do you think? Um, and that's how we ended up really partnering each other. It was 12 months of an interview, basically, when things were much slower. And then now we have started a company together.
I love it. Yeah. So, and I think that's a really good lesson for the listeners is that I think a lot of people come into the space and they expect to make a bunch of money right out of the gates and they want to get paid big dollars because they're used to making big dollars. But you literally worked for free for a full year with no guarantee of anything coming on the back end, but you knew the education process is really the value that you were getting out of that.
You got it.
I love it. I love it. Okay, so a little bit different than a lot of folks. Most people I see go single and then passively invest and then jump into the syndication. So you jumped off quick. So now, did you have? I know Steve, who's now your partner, was a big influence and mentor to you. But did you do any formal education or formal mentorship before you jumped in as well?
I learned with Steve concurrently while listening to podcasts, reading books, going to whatever meetups that were all virtual at that time. And I did decide the following year to join a group, but I did it mainly for the networking and meeting other like-minded folks who were in the same kind of life stage and journey that I was in the syndication space. So it's just like I would say my advice to folks jumping in, figure out what works for you. If you're able to find a one-on-one mentor who, is willing to take the time to coach you, fantastic. But if you also want to spend dollars on a coaching program, those are phenomenal as well. You just need to find the right one that shares your value and, more importantly, where you click and connect with. Because there's tons of programs out there today, but the ones that are worth it are the ones that you actually connect with and where you find a lot of values that are similar.
Yeah, that is such a good point. There are so many different options out there of people that have had, I mean, real life experience that bring that to their students. But it is so much like who do you connect with, and who are you willing to like go to the line and just battle this thing till the end together. And I think if you find folks that the know like and trust thing is a little cliche, but really people that you connect with and click with, partnerships will form even without that necessarily being the goal. So um, that's awesome. So you guys started, or you and Steve joined. Steve had already started to build a pretty good portfolio, and then you essentially just added on your expertise and your business acumen to that model, and you guys started to see some success pretty quickly together. Can you talk about that a little bit?
Yeah, yeah. I think by the end of 2020, we had together purchased a few properties. It was two properties actually closed on the same day in December of 2020. And that was my first two syndications. They're very different. One was a small 28 unit property in Glendale, and the other one was a 176 unit property in Tucson. So two very different properties. Um, and then fast forward, to the 2021, we purchased, I think, 7 properties in 2021. Now, it was collectively with other partners that we found, again, know, like, and trust and connect with is super important. But as we built and scaled, we were able to figure out what we were good at and then who we wanted to work with, then start creating some systems and processes that allowed us to scale even more in 2022. So that part is super important. And when if you are on the active side, finding strategically finding the right partners to complement your skill sets and styles. That's the second part people don't talk about, but is really important. The style aspect of it is how you would want to scale and grow your business.
Okay. Um, Can you talk about styles a little bit more? Because I hear aligning your superpowers with other people's superpowers where your weaknesses are. And I know that you and Steve both are sales director background individuals. So um, you usually don't see two salespeople coming together and joining forces. So maybe talk about that as well as what do you mean by the style piece of it?
Okay, so the superpower thing. So just for folks who don't know, there's a couple key roles in a partnership, right? You have is in multifamily specifically, you have the acquisitions person, capital raiser, and asset management, right? So if you're not good at one or three, you need to find people to fill that gap. However, the style piece is just as important because I say this because I've seen a lot of divorces in businesses too, and it's really because of what? Why do people get divorced? It's lack of communication, different styles. And what I mean by styles is, let's say, here's an example. Let's say you, Randy, love to work at 5 o'clock in the morning, but I love to work at 10, 11 o'clock at night. How are we ever going to be at our good time frames, right? Where we can actually collaborate together. Or you love phone calls, whereas I love text and email. That's a struggle of communication as well. So, those are two very simple examples. There's many more, but if you guys don't identify that early on, there's going to be some problems if you don't identify it early to solve for and all of that. So, superpowers, absolutely, but then also complementary or understanding of styles is key.
I love it. And it's interesting now, kind of shifting a little bit from business partnerships to client customer partnerships as well. I think that style comes into play just as well. So I have a very unique type of style, which does not blend well with certain investors. But then there are certain investors that absolutely love my style. So I think you find your tribe both in business and from a client standpoint just by being transparent, being genuine, and then truly showing up who as you truly are versus trying to kind of please everybody, right?
Yeah, agree. And to the point for investors, I currently invest with a few other syndicators myself as a passive investors, and I would say communication style is one factor on whether or not I'm going to invest with them again. And so here, an example of that is, for us, we send out monthly newsletters and we try to be as detailed as possible on key buckets of work areas, and we share our financials. All of that is pretty transparent. One, syndicator that I invest with, their emails are two sentences, right? And to me, that's not a good indication of how they operate and how they are transparent with their investors. So I most likely will not invest with them again in the future. Even though, sure, I'm still getting the distributions, I just asking questions, finding information is a little bit tougher to do. So that's an example of how communications can translate to the investor side as well.
Yeah, no, I agree 100%. I would prefer less returns with better communication than better returns with no communication. Because there's a 3 to 5 year period where you're waiting to see whether this is going to pan out the way that you think it is. So, um, I personally don't like the stress of the lack of communication.
Yeah,
So,
you don't want to be
um,
surprised,
right,
an
right,
investor.
exactly.
Yeah.
And as an investor myself personally in Vertical Street Ventures, I can vouch for just amazing communication. You guys are always very transparent on what's going on and always open to communicate with investors. So it shows through down to the investor level that that's your intent and you're actually executing on it. So very good. Well, let's if we can shift a little bit over. Just simply, you've got so much experience. I want the audience to be able to get as much as possible from this. So, can we talk a little bit about, the standard thing that comes up is how do you vet operators? What is the best way to find good deals? Like, share with us your experience around that and kind of your how tos to the passive investor on how to get the best results.
Yeah, I think my top tip for new investors is to actually Of course, vet the deal as best as you can, but more importantly, you are vetting the sponsorship team. Okay, because a good deal can be butchered if you have a bad team, and vice versa can happen. And so I would encourage folks to actually spend more time in doing their due diligence on the sponsor and the lead operator on the project. And think of it like an interview. So just like you would interview somebody who works for you, set up a phone call with them, understand their track record, their experience. You can ask for referrals. So I always ask new syndicators or who I'm investing with for the first time. Hey, can you give me a couple of names of your current investors? I'd love to chat with them and understand what their experience was. And if they're hesitant to give you some names, that's probably a red flag. I've also asked for an example of their monthly newsletter if they're willing to share so I can see how they communicate. And then I ask questions when you're interviewing them. Give me an example when projects go bad. I do not expect every project to be perfect. Not every single one of our projects are perfect. You're going to have some good eggs, bad eggs, medium eggs. But tell me an example of when, one of your projects isn't doing well. And how did you solve it? What is your process to solve the problem? So treat it like you're interviewing someone who's going to come work for you, and ask all those questions.
I love it. And I love the asking the question about when things went bad, because that is, um, I'm surprised how many people will say, "Oh, we've never had any challenges," or "We've never had a deal go bad," and immediately it tells me that either one, this person's not being transparent, or they're not being honest, because these are large organizations with a lot of moving parts, and things change, so very unpredictable. So, yeah, I think that is a really, really good point. I've always wondered, the referral piece. Um, I struggle with it. I think it's a lot of people go to that, and I have done that a lot in the past as well. Um, but I know a lot of people have a handful of folks that they can refer, and I've been burned where I've asked for referrals and things did not turn out well, just simply because it was a referral that almost had been staged, right? So trying to find what I like even more is finding people that have invested with them separately from the operator providing those to me, because I think that's a better indication of what type of results I'm going to get from them. But it makes sense to talk with other people that are investing with them for sure.
That's a great way of doing that too. I agree.
Yeah. Well, very good. Let's see here. So we've seen a lot of shifts in the market. We see a lot of properties that we're hearing a lot about capital calls. We're hearing a lot about pause distributions. Um, Talk to me about that and how your organization and even your own personal investing journey, how that's impacting you and how you're handling that.
Yeah. So from a passive side, a handful of my own investments that I've put in with other folks have seen a pause in distributions. And I would say, as an experienced investor and knowing it from the other side as a syndicator, I understand why. So as long as I understand why, okay, that makes a world of difference. So if they're pausing distributions because they're not operating it well, that's kind of a bad signal. However, if they're pausing because, yes, interest rates have gone up, they have a rate cap that's protecting them from a, kind of an insurance standpoint. They're just protecting capital in the account, that for like a rainy day or to build out the reserves, that makes more sense. And that's what we've done too on some of our properties, just to hold capital and protect the investor from that standpoint so that we don't have to do a capital call. And we haven't done one yet. And so, yes, it has impacted everyone. I can't imagine anyone saying, no, the environment is not impacting me. That would be false. It's impacting everyone. It's just, how do you manage through that? And what is your plan 3, 6, 9, even 12 months out? And do you have, plan A through C or D or E to cover, to make sure you're covering and protecting your investors? That's important.
Yeah, no, thank you. And I think any experienced investor that's been in the space for any amount of time realizes that pause distributions are part of this. If it hasn't happened yet, it's not really if, it's more when. If you have a lot of dollars in the marketplace, capital calls, I'm learning more and more, is actually a reality in this space as well, and not as uncommon as what we would all like it to be. Um, And I think that's important for the investor to know as a guy who also works with partners and brings dollars to investments. It's not a really comfortable or exciting thing to talk about on the front end, but it is a reality. And I think that transparency with that is extremely important so folks aren't caught off guard when these things happen. So, um, and I think it comes back to that communication piece, just like you talked about. If you have a regular cadence of communicating regularly with your investors, then a lot of the pain that people experience from this is actually avoided when these, unfortunate things do come up. And you guys have done a great job with that on my investments with you. And I think, but it's important to know that not all operators are as transparent as you guys are, and not as many operators have the professionalism and the business acumen and the experience that you guys have. So it ties back to that interview process that you talked about, because this is an interview. We're looking as investors for people to be good stewards with our dollars, and if they are, there's going to be ups and downs, but over the long haul, it's going to be very, very positive. So um, yeah, thanks for getting it. That's an uncomfortable conversation quite often, but you guys do a really, really great job with that. So thank you. Um, so yeah, where do you see the next few years in the space for you guys, for Vertical Street, for the market? What are you guys seeing? What are you expecting?
Yeah, it's hard as an entrepreneur, growth is important and you want to grow profitably, of course. In the industry, it's tough to say because, last year we bought 7 properties. This year we have our first 2 under contract and it's already June. So, yes, it is truly a cycle in this industry of when you see good deals. I would say, we just want to find continuously good properties to invest in. And it's okay that it's taken us 6 months to find a good one. So far, we're being, you know, intentionally patient, and making sure that we're finding a good one. And we just launched a new fund recently, last month, I believe. We have the first 2 under contract, but as we continue to add more, we're going to be very diligent on making sure that it makes sense. We've learned a lot over the last 2 years with this environment being the way it is, and how do we better protect our investors moving forward? That's what we're pushing more into the underwriting. And so, do I have a number for growth? Not necessarily, because I think it's going to be market dependent. But my intention is, and our whole company's intention is to always put 2 people first, our investors and actually our residents. Because we just launched initiatives. You heard about it at VSV Con, but it shouldn't just be the investors that benefit from syndications and real estate. Our stakeholders, people who live on the properties, should also be able to benefit as well. So that's a big initiative we're working on right now.
Love it. Yeah, and I actually had Kyle on the show, I think a month or two ago, and he talked about your Residents First program, which is out of the entire conference, and we'll get into this as well. You guys do amazing conferences, but out of the entire conference, that presentation where you talked about that initiative, like literally gave me shivers, and it kind of brought it full circle for me. Like, this is not just about investor dollars. This is truly about creating amazing living experiences and assets for our tenants to live in. So I love, love, love you guys are spending so much time there. And I think to your point, you guys being much more selective in the deals that you choose is really, really important, because the best deal you can possibly do is walking away from a bad deal, because one bad deal in a fund environment can have a really, really, or even worse yet, in a single asset environment, can have a really significant impact on the return. So, I'm curious if maybe we can talk real briefly, and I know we're already coming to a half an hour here, but I'd love to hear your thoughts on fund versus single asset investing and kind of the pros and cons and why you guys are going down that path as well.
Yeah, absolutely. We traditionally have had single asset syndications, which, has pros and cons. We've moved to this fund model, and this is our second fund. We did one, call it a 2 property small fund 2 years ago, and that's been performing phenomenally. But we actually had investors come tell us, hey, in this environment, I would love a little bit more diversification. And so that's how, we proceeded with this new structure in a fund. Eventually, it's going to house 6 to 10 properties in Arizona and Texas to provide that diversification. That's a pro, right? For folks looking for diversification, that's definitely a pro. It's still simple. Like they get one document to sign, not six or 10. They get one K1 every year in a fund. So it's still very simple to manage. The negative of it is that you don't get to pick the property. So in a single asset, you can decide yes or no, I want to invest on this particular property in this city in the state with those returns. In a fund, you don't necessarily get to do that. We are going to be placing properties into the fund as we go. You will just benefit from choices and the diversification that we provide. So that's one negative that some people might say is why they don't choose a fund.
Got it. And only getting one K1 at the end of the year, being a guy who just like had 23 that I was shuffling around, is a really big deal. So yes, I love the diversification play. I also like that, if you even if you invest in 10 different single assets, you're going to have some home runs, you're going to have some singles and some doubles and maybe a dud. It really kind of smooths this out where you're seeing much more risk adjusted returns with less high extreme highs and less extreme lows, which I think as an investor with just the emotions around the ups and downs of the stock market, I'm trying to do everything I can to stay away from that. So I think the fund model is a great idea, definitely. Well, let's, if we can, we're already at about a half an hour, so I want to at least give you an opportunity to talk a little bit more about the things you guys are doing. I know you do an amazing conference. You guys have an academy. There's all kinds of things going on with VSV. So, yeah, what are you guys excited about today?
Yeah, at the core of it and why we even started the company is just we want to impact people and, pay it forward because we are benefiting from the income coming in from passive investments and syndications. And we just want to spread the word. And that's why we started the company. We want to help more investors get into their version of success, which is financial independence, which is why we launched the conference. We wanted to bring more people together to further that education. And it's one of the reasons we started our coaching program to help other people become syndicators as well. And so I'm excited about all of that. Can I be excited about more than one thing? Okay.
Absolutely. Yeah,
Yeah,
absolutely.
so
Yeah.
all of that. And so, on the other hand, we also started our own CPA firm with one of our other partners, Kyoshi. And so it is in the spirit of just how do we reach more people and help impact more lives from investors to clients to residents. That's kind of at the forefront of, every time we get together as a lead team to talk, it's how do we build on each one of those components. So that's what I'm excited about in the next year, 5 years, who knows?
Yeah, no, absolutely. And I've attended some of your more intimate uh, group connections that you guys do. I've been to your conference. Know a ton of people that are in the academy and just rave about the content that they get and the fellowship and the community that they're generating. So you guys are doing an amazing job. Thank you for all you guys are doing. And it really kind of ties in super nicely with what we're doing here because our goal is really just to educate and inspire passive investors to the point where they can take the action and get in their first opportunity. Because once you do, it's a game changer. It can absolutely change your life. So thank you guys for everything that you're doing. It's an amazing thing you're doing.
It's our pleasure.
Well, very good. I do have a few questions that I like to ask at the end of every podcast. So you can't get out of here just yet. But is there one specific education resource that you would suggest to the new or newer passive investor?
Education resource. So I would highly suggest podcasts. Is probably the easiest thing that you can just do right now, whether you're commuting, yard work, household chores, whatever. Find a handful of podcasts that you enjoy, and I have a list of curated podcasts too, so you can reach out to me for my list. I'm happy to share. But those are just quick, easy ways to get educated. And I listen to it on 1.5x, sometimes 2x, and that just gets you through it a lot quicker. So podcasts are the easiest things that you can get into as a new investor.
I love it. I love it. Very good. And one in particular that you want to point out, or is there a favorite that you have?
Yeah, right now I'm really enjoying the rate guy, JP Conklin
Okay.
from Pensford. He
Yeah,
does a really good job of synthesizing everything that's going on with the market right now in terms of the Fed and unemployment and all the key metrics out there. So it's fun.
I
It's
love
fun
it.
to listen to.
Yeah, I've heard of him. I've not listened to the podcast, but that's a good one. Another one that I like that stays very close is Old Capital, based out of Texas. Again, just kind of economic trends and things like that. And really, they seem to have a good pulse on what's going on in the marketplace. So, okay. And then kind of a fun one. Is there a recent bucket list item that you've checked off your list or one that you're hoping to in the near future?
Last summer, we did an Alaskan cruise. That was so much fun.
Fun.
And if you haven't
Yeah.
done it, it's on your bucket list, do it because those icebergs are melting. So it's a little bit
Literally.
sad. It's a little bit
Yeah.
sad to say, but they're quickly receding. So go and see them sooner rather than later. So we did that last summer. And then this summer, we're all about experiences. We're looking to take the kids camping. I'm not a camper. I wouldn't survive by myself. But
Sure.
I think it'll be a fun experience to try out as a family.
Absolutely, absolutely, very fun, very good. Now, I've always wanted to do the Alaskan cruise and haven't done it yet. And then camping, of course, is always a blast. So thanks for sharing. And how can our audience find and support you guys in Vertical Street?
Yes, visit our website, verticalstreetventures.com. Our contact information is there. We're on all social media platforms. Email me. I love talking to investors, especially newer investors, because that gives me energy and I get excited for newer investors. Reach out for any questions or would love to connect just to get to know you.
Well, Jenny, thank you so much. You brought just a tremendous amount of value. I really appreciate and respect everything that you and Vertical Street are doing. You guys bring so much value to this community. So thank you guys for what you're doing.
Thanks for having me, Randy. It was a blast.
And to our audience, as always, we encourage you to continue your education and your inspiration path. And more importantly than that, we encourage you to take that step in investing in your first deal. I'm convinced that once you'll do, you will wish you would have started sooner and you'll get one step closer to decreasing your dependence on your W-2, just like Jenny and I have done all through passive investing. So have a great day and join us again next Thursday for another awesome episode. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.